Hello and welcome. You tune into News Now with me, Ankita Saxena. Well, the Wall Street posted stellar moves on Friday as it digested the Fed Chair Jerome Powell's commentary at the annual Jackson Hole Symposium. He signaled that the Fed may cut interest rates in their September meet. The blue-chip Dow Jones saw a record close yesterday to end over 800 points higher, and the S&P 500 and Nasdaq also closed with strong gains. Now, the S&P 500 ended the Friday session about almost 1.5% higher, and the tech-heavy Nasdaq saw gains of 1.8%. Now, all the Magnificent Seven stocks soared in trade, with Tesla closing about 6% higher. And if you look at the commodities market, the precious yellow metals saw a rebound as hope for a September rate cut picked up. Now, spot gold rose 1.1%. Meanwhile, on the flip side, the dollar was down about 1%. Now, it is an important development that's coming on, but we'll move on and we are going to discuss the 2025 Jackson Hole Economic Symposium. The Federal Reserve Chair Jerome Powell, in his address, spoke on the labor markets in transition. He signaled a cautious approach to monetary policy, balancing persistent inflation above the 2% mark with a softening labor market as unemployment hits 4.2%. Now, with markets eyeing a September rate cut, Powell remained non-committal, emphasizing data challenges and central bank's independence and political pressure, but also dropped in some positive hints. Now, let's go across firstly and listen in to what Jerome Powell had to say about the labor market and the effect of tariffs on prices. Let's listen in.
The labor market had cooled from its formerly overheated state. Upside risks to inflation had diminished, but the unemployment rate had increased by almost a full percentage point, a development that historically has not occurred outside of recessions. Over the subsequent 3 Federal Open Market Committee meetings, we recalibrated our policy stance, setting the stage for the labor market to remain in balance near maximum employment over the past year. This year, the economy has faced new challenges. Significantly higher tariffs across our trading partners are remaking the global trading system. Tighter immigration policy has led to an abrupt slowdown in labor force growth. Over the longer run, changes in tax, spending, and regulatory policies may also have important implications for economic growth and productivity. The effects of tariffs on consumer prices are now clearly visible. We expect those effects to accumulate over coming months, with high uncertainty about both timing and amounts. The question that matters for monetary policy is whether these price increases are likely to materially raise the risk of an ongoing inflation problem. A reasonable base case is that the effects will be relatively short-lived, a one-time shift in the price level. Of course, one time does not mean all at once. It will continue to take time for tariff increases to work their way through supply chains and distribution networks. Moreover, tariff rates continue to evolve, potentially prolonging the adjustment process.
All right, we're now joined by Andrew Ferris, CEO of Ecogenesis Advisory, and Peter Maguire, CEO AustraliaTrading.com, who are now joining us to weigh in on what transpired at the Jackson Hole meeting. Hi, good morning to both of you gentlemen. Thank you so much for taking the time out and joining us today. Well, first off, let me come to you, Andrew, about the stance that has turned from hawkish to dovish. And I quote that what he said was that baseline outlook and the shifting balance of risk may warrant adjusting their policy stance. How do you read into those comments? Your first thoughts on what Jerome Powell had to say?
Absolutely nothing new. They have been saying this all the time. It's going to depend on how and where the economy is going. There seems to be a shift towards the labor side, but at the same time, they're worried about inflation. What I find when the Fed is telling them that we have to cut interest rates because the economy is getting worse, and that's great news for the equity markets. Sorry, I really fail to see that. I'm not there to tell the equity market what is right or wrong, but I laugh behind my hand that it can be such a stupid reaction. Well, there you go. Okay, the Fed is telling you they're going to cut interest rates potentially because the economy is not doing very well. And that is, of course, very good news for Mr. Trump as well, that wants cutting interest rates because he wants cutting interest rates without stopping to think that if interest rates are cut, it's because the economy is doing worse. And if the interest rates are not cut, the economy is under the inflationary pressure primarily through the pass-through of the tariffs. So, neither the stock market nor President Trump can possibly see any of this as good news. I admire Powell for actually telling the truth, because he actually says we don't know. We have to wait. And some interpretation is that they will perhaps cut interest rates once and then wait. That makes some kind of sense.
Do you mean that the markets have perhaps they have overreacted and perhaps they've thrown caution to the wind, if you will, and this is over exuberance on something which is actually a very cautious note by a Fed chair, but clearly, I mean, we were looking for some positive triggers, and lo and behold, that small commentary that came out has been overpriced perhaps by the market?
Well, I'll repeat it. When the Fed says they're going to cut interest rates because the economy is not doing well, that's not good news for equities. Well, what else can I say?
Okay, let me get in Peter also on board. Peter, what led to this U-turn? Now, Fed might not wait for the perfect inflation before slashing rates. That's what he said. Has the focus now shifted clearly from inflation to labor markets? And they're probably, why are we not pricing in the inflation that perhaps can come across as a result of the rising tariffs? Are we not pricing that in?
Yes. Hi, Ankita. Good morning. And building on what Andrew said, I mean, the next part, of course, is, are we to see one rate cut? Are we to see no rate cut that it hasn't been baked in yet, or do we see 50 basis points? So I think as we look through in the framework as far as Fed Chair Powell, we're very conscious of the decision. And as you mentioned, as far as a labour market perspective, there's certainly concern there as far as the edging up of the unemployment rate and the impact naturally. We're looking forward to this upcoming non-farm payroll number being released in early September, first Friday. That'll give us a good indication. You've got the next meeting on the 16th and 17th of September. Now, if it was a very, very soft number, that may have another effect as far as Fed Chair Powell's planning on this. So I don't think anyone can say it's an absolute guarantee that we're going to see a rate cut. The other part of it, of course, is, yes, you've got the tariff situation. Who's going to warehouse those costs? Is it going to be the country, or is it going to be the consumer in America? And this is another factor from an ongoing, I suppose, situation from when you're looking at strategy in business and you're looking at how to maintain your pricing, or do you absorb some of these tariff costs for the benefit of actually having that US consumer being able to buy your goods? So there's a lot to work through on this. We're only at the early stages, but yeah, it was a little bit surprising to see the markets, NASDAQ up nearly 2%, the S&P 1.5%, and you had the big push up, very, very strong for the Dow.
Right, and keeping with that, Peter, so the risk on sentiment is back on Wall Street, right?
Well, I tell you, I mean, I've been saying this for a number of months now. If you stand in the road of it, you'll get run over. It's quite simply, very, very difficult to be short at the moment as far as US equities. Everyone can have an opinion, but the market just keeps on hitting high after high after high. And I feel as though that the momentum, really, really strong, that S&P, it's if this is the situation and this does evolve to a rate cut in September, then I think that you're going to see a continual uplift, certainly into October. A bit hard to see whether you're going to see another rate cut sometime by the end of the year. I mean, if you listen to Scott Bessent, he's saying he wants 1 to 1.5% of cut. President Trump wants a number of percent of cut. So that's very, very dynamic at the moment. And I think we've just got to wait and see how it all plays out.
Right. Right. I mean, of course, the markets are running up like nobody's business. And if the rate cut doesn't come through, it's going to be a big dampener. Andrew, let me come to you. Are the markets really playing on the placebo effect? And should there be any downside surprises in store, it could lead to a big blow to the markets in that case.
Oh dear, here we go again. Poor Powell can't have it both ways. Okay, he actually says that we have to look at data, and some of that is balanced for a rate cut when it comes to the labor market, and some comes for an increase when it comes to inflation. I'm afraid, as an ex-academic, I have to hang on to facts, not to opinions. There is overwhelming academic evidence in the past that tariff increases in the United States were passed by anything from 50 to 100% to consumers. Full stop. So as an ex-academic, I tend to rely on what my colleagues in the past have dealt and found out that when you impose tariffs in the United States, it's the consumers that pay them. As the Powell said, it is not a one-off effect. It dribbles through because individual sections of the economy under different aspects of tariffs and under different capacity to pass them through. But they will pass them through, and it's not going to be in the next 5 minutes or in the next year. It might dribble out over a period of time. Even if we say, okay, we leave it for 1 year, the liberation date came out very early in the year, so we have till September, till January to February. We're talking about 1927, not 26, a year later. So it is not easy, okay, to wriggle away from that. But clearly, the Secretary of Finance and President, why should they pay any attention to those things? They pay attention only while it is conveniently politically. And I think we're in for a surprise that the pass-through of tariffs is going to be much higher than expected. Full stop. And therefore, the expectation is going to be that the Fed will stop cutting interest rates. There was even some people clearing their throats and says that the Fed may very well increase interest rates. I think that takes it to the other extreme, okay, because it is not a balanced approach.
Right, Andrew, so you're saying that, 50 to 100% of the times historically we have seen that any kind of a tariff increase has always been passed down to the public, and eventually that is what is going to happen. If not now, then months down the line, it will start showing in the inflation numbers. And therefore, perhaps after this rate cut, which has been so talked about, and there's so much of pressure on this September rate cut, perhaps there is a chance that there may not be a rate cut. And of course, the worst case scenario, and could be a hyperbole, that there could be a rate increase as well. Peter, what's your thought on that?
Well, if I listened to Kansas City President Jeffrey Schmidt earlier in the week, that he was saying he was hawkish, and he said that you could see a possibility of a rate rise. So that was what he was saying, wouldn't surprise him, he wouldn't dismiss it. They were his words. So building again what Andrew mentioned, I mean, there is the possible four scenarios: 25 or zero rate cut, 25 cut, 50 cut, or 25 to the upside. So I'm erring on the side that you will probably see a 25 basis point cut in September. How it plays out from the perspective as far as employment and naturally to the inflation data, that's going to be something that we've just got to work through. A counter argument possibly is a considerable downdraft as far as US crude prices. That's going to be a helping hand to the consumer. Everyone's saying that you could see the energy prices start to really unwind over the next couple of months. Again, we've got to wait and see how that plays. And it's all very much a work in progress leading up to Christmas. Right.
Peter, let me stay with you and talk to you about the movement in the asset classes now. We did see the US markets, the Wall Street jump up, and like Andrew said, it was perhaps unnecessary exuberance to what we saw, the kind of moves that we're seeing on Wall Street. But what happens to other asset classes? If the interest rates come through, of course, the dollar cools off. We will see the bullion jump up. What will happen to asset classes? What are your thoughts on that?
Well, you're looking at the 10-year, it's down 425, 426. So it's been punched down a little bit. The VIX was very interesting. It was down 14%. So back down to about that 14.3 sort of 14.5 sort of number, 14.2 it is. US dollar index 97.70. So I feel as though we've had a big push up as far as bullion or gold, 34.18. That will probably take another lick up. I wouldn't be surprised for that to happen as far as the gold market. And silver was up $39.55. So there was a return to precious metals and a very, very solid move. And I feel as though that will probably play into this rate decision it'll oscillate between now and then if the rate cut does come through, I think that'd probably push more softness as far as US dollar and push the certainly the precious metal market to record territory leading into Christmas.
Right. Right, Andrew, this is interest rate cuts could be a big positive for the emerging markets as well. The dollar index comes off, the bond yields cool off. It is a positive for emerging markets as well. What happens to India? Where does India stand in the whole gamut of things? Because there is an ongoing tariff tussle that's been going on with the US.
Well, there are two things here. First, interest rates and emerging markets. The majority of the emerging markets have been cutting interest rates for nearly a year now. And, I have moved years ago away from the idea that we are all linked to the US dollar. No, we are not. Okay, and therefore our interest rates are not. Look at the RBI. It has cut interest rates twice, if I remember well, at the beginning of the year, and possibly it will cut again because inflation is okay. And this has nothing to do whether the Americans are cutting or not cutting. Can we please move away from the fact that we are moving, locked in with whatever happens in the United States? No, we don't. We, meaning the emerging markets in general. Okay, so now in the case of India, yes, there is still the overhang of the possibility of an extra 25% added on, although this has not been yet confirmed because, of course, Trump is now caught in the very awkward argument that I'm imposing 25% on India because they are buying oil from Russia. And somebody says, so does China. Why you're not imposing a 25% rate cut on China either? And I'll tell you the answer is because the Chinese will not put up with that. So I would like to see that Prime Minister Modi leading 1.3 billion people, leading to a truly a politically savvy economy, will also turn around and tell the United States, go ahead, put another 25%, and I'll match it with another 25% on whatever inputs you are sending us. It has to be like that. Trump's bluff has to be called. The Chinese did call them, and guess what? They got another extension till November. All right, in other words, when people put their foot down, okay, Trump backs down. I would really expect to see that Prime Minister Modi will do likewise. And that will release us from this business on where it will or will not be. And incidentally, my own calculations on the impact of India's GDP of even a significant drop in exports is not anywhere near the exaggerated notions that the GDP growth is going to come down by 1%. It's going to be very boring if I try to explain, but I will leave it at that.
Andrew, one last question from you, and then I'll come for closing comments to Peter as well. Andrew, you mentioned how China, they would never do that to China because China wouldn't stand it. But having said that, India has also been fairly resilient and has given a fair pushback to the US. In fact, we have that upcoming meeting with the US onward that's coming to India for the tariff talks. And of course, there has to be more, to Trump's just imposing tariffs on India because we import Russian oil, because clearly China is the largest importer of oil. So there is clearly something else that is at play. But how do you see these tariff talks pan out? Because India has given a fair amount of pushback as far as tariffs are concerned. And come this 25th of August, where we have the meeting, what could perhaps be the likely outcome?
Well, look, it's not my business to give advice to the Indian government. Is to pass on a comment. Getting a 25 overall rise, now it depends where and how it's going to be spread. It took India 3.5 years to sign the agreement with UK. I'll say that slowly, 3.5 years. And that was recent. It was signed about a month ago. And apparently both countries were very pleased. Now, United States insists that this is done in a month. Again, this is what I'm saying. I'll put my foot down and I'll say, I'm going to drag it. I want another extension, just like China got. Okay, we'll talk and we will negotiate. But I'm not going to negotiate with a gun on my head. If, in fact, Trump wants the stuff signed tomorrow, he's not going to get it. He's going to impose his 25% extra tariffs, and I would expect that India will do likewise. The example with UK is very nice example. Okay, and it should be taken on. And I have looked at the details, and it is mind-numbing. It is a volume this thick. I mean, of course, you don't do trade deals like that. You do a trade deal that's going to last for years.
Right, right, Andrew. Point taken. Let me come to you, Peter, for final closing comments. Now, I want to get in a quick word on the prices of oil and the metal movement, the commodities, if you will. We did see the oil prices go up for the first time in the last 3 weeks, and there is still a lot of uncertainty as far as the Russia-Ukraine peace talks are going on. How do you see oil to move, therefore? And also talk to us about the movement in the metals. There is strong demand for metals as well. Any positive triggers coming in from China in terms of demand that could also help the rally in metals?
Yes, absolutely. I'll answer the last one first. Certainly, as far as Chinese demand, that's very strong for the industrial metals, and you've got copper sitting just under 10,000 a metric ton, aluminium, tin, all of those are relatively strong at the moment as far as price. When you're looking as far as the energy markets, one would think, and this is the deal that was put together a couple of months ago as far as President Trump and MBS in Saudi, the Crown Prince, that the situation certainly in Russia, if the war was to be discontinued between Russia and Ukraine, and that possibly may happen over the next matter of weeks, I'll put that out there. If that's what was to materialize, I think you would see a couple of dollars stripped out from any form of premium in energy prices. There's the first part of it. And then the second part would be the continuation as far as push down or oversupply of oil is going to be good for consumers, because I think there'll be more on the market, and that I think OPEC Plus are nearly having, we all understand the barrels that they're releasing and the increase in supply. And then the other side of it, of course, is, as I mentioned earlier, continuation as far as uplift for precious metals in the next couple of months. The rally, I think, is going to continue, and I think it's not a bad place to be. It's not bad over what we've seen this year, and that will continue very much to the future.
Right, Peter. Thank you so much for those comments, Andrew and Peter. Such a pleasure to have you on the show today, and thank you so much for weighing in all that is transpired in the global markets overnight. Thank you so much for taking the time out and joining us. And well, with that, it's time for us to slip into a short break. Don't go anywhere. After the break, we'll get you more updates on the other side. Stay tuned.